Let's talk about our risk management here. $10,000 account, right? That's going to equal a $250 maximum risk based on the reward on the risk of ruin matrices that we have discussed in here for directional trades. Any one trade, $250 max risk. I would not have more than probably 2 or 3, typically 3, 7.5%, exposed to any one industry or sector. So that's my maximum risk. So if that's you know, a $2 contract times 1 with no stop, right? If you've got a smaller account, or you know someone, right? Because no one in here, but if you know someone who has a $5,000 account, that means you've got $125 of maximum risk, which is a $2 option times 1 contract with a $1 stop. Okay, so I'm literally, I mean, a dollar is a pretty good bit of wiggle room in it. I'm still very unlikely to get stopped out here. Now let's go down to a $2,500 account. Okay, means that now you're dealing with half of 125, which doesn't divide these evenly. $62.50 is your maximum risk. Okay, so now you're looking at $62.50 as your max risk. Which is a $2 contract times 1 with still a 50-cent risk, right? A 50-cent stop. Now you'll notice that each one of these still provides with some cushion to absorb the bid by ask. Okay, $62. Julie, that's a $2 contract with a 50-cent stop, or in the example that we just looked at, okay, as an alternative, we went in and what do we buy? We bought a let's use $1. It was around $1, right? It was like 97 cents or something. $1 times 1 contract, right, with a 50-cent stop. Yo, that's, think about it. You're talking about a 60 delta with a 50-cent stop. That means that Green Mountain Coffee Roasters could move against you almost $1 and not take you out. And the thing I like about trading this way is that we are trading with a focus to risk, not to reward. And I don't know about y'all, but so far it seems to be working. But remember, you've got to absorb bid by ask spread in here. Again, guys, look. In each of these, so let's do some examples here. This is going to equal a let's see, $2 one is so a $200 loss. Okay, and here you're experiencing a $100 loss, right? And over here in the first example, this is going to be a $50 loss. And this one down here would, well, that would also be a $50 loss. Okay? So in these examples, in each of these examples, have we lost less than our total account risk limit in each one of these examples? The answer would be yes. Okay, and guys, we're trading. Here's what I'm trying to do with this strategy. The idea here is to trade with the maximum stop possible while maintaining the minimum risk possible. Does that make sense to everybody?